Listen, when I first got into the workforce, okay, my first official job was working at Einstein Bagels, cleaning dishes in the back. Then from there, got a job at Walgreens, okay? Okay, get into this job at Walgreens, and I get bumped up to $8.75, and then I got bumped up to $9.10 an hour. Now, I was so thankful for that. So thankful. Oh my gosh, got bumped to $9.10 an hour. So, wow, I'm so fortunate for that, right? Why was I so thankful? You might look at it, $9.10 an hour? It really comes down to, I didn't know my own value. I had a lack of experience. So if you don't know your own value and you have a lack of experience, whatever you can take, you'll take it, right? No different than if you don't know the value of a stock, you're going to take whatever you can get. If you buy into a stock and it goes up 5%, right? And I don't know, you make a few $100 on that, you're so thankful. You're like, oh my gosh, I'll gladly take that profit. So people take profits very quick on stocks when they don't know how to value them, right? And when they have a lack of experience. They'll be happy with a little quick gain. And I was the same way when I first got in the market, right? When I first got in the market, if I made 10% on a stock or 20%, I was like, oh my gosh, I just made 20% on a stock. Sell, right? Because it's just you're not used to that. You're just thankful. You're like, I'll take whatever I can get. If I can get 20% on a stock, that's amazing, right? And then I would see those stocks go on over the coming years to go up another 50%, 100%, 200%, 500%, right? And I'm like, why? Why did they do this, right? Because I didn't know how to properly value them, and I had a lack of experience. And so you take profits way early on stocks that have great long-term trajectories, right? Same thing. When I was 25 years old, I started my real estate marketing company out here in Las Vegas after I moved to Las Vegas, right? And I would price jobs at $99. I would do a whole community tour with my drone. No one was recording with drones back then. I bought a super high-end drone, would fly it all over a community, record all this footage, edit all the footage, put in all the branding for them, all for $199. Somebody else would charge $1,000 for that, but I didn't know my value. I just knew this is what I think it's okay. And so I would go ahead and do it. When really I probably could have got $1,000 for those same exact videos, right? I was new to a space. So I didn't know my value. And if you don't know your value, you're going to take whatever you can get. And the same exact thing happens with stocks, right? Palantir is a great example. Palantir stock. I wasn't the only person that bought Palantir for $7 in 2022. There was other people as well. Plenty of people. A lot of retail investors, traders bought Palantir at $7 in 2022. Some even bought it in the 6s. Some bought it at the 8s, right? And then Palantir starts to go up. It starts to go on its run. People said, I'm going to take my profits at 10, so they sell out. Other people said, you know what? No, I want more than that. I want to double up. I want to go to 15. When it gets 15, I hit my double up. Boom. And you got to understand, you buy a stock at 7, it goes to 15, you double up your money. That's all the money in the world. Especially if you're a new investor, you're like, I just doubled my money on this stock? Are you kidding me? In a matter of 6 months, 12 months, 18 months, whatever the time frame is, I'm taking my profit. Then there's people taking it at 20. 25, 30, 35, 40, right? Today, Palantir is over $180 a share. Over $180 a share. Imagine you sell Palantir at 15, you doubled your money. You bought at 7 something, you doubled your money when it went to 15. It's an amazing feeling. But let me ask you this very important question. How do you think that person feels now? That they sold at 15, all to watch it go up another 10x plus. Now, somebody like myself looked at Palantir at 15 and was like, the stock is still significantly undervalued based upon where I see the growth rates going, based upon where the balance sheet's at, the income statement, where I think the margin profile is, right? So I looked at Palantir at 15, I'm like, I have no interest whatsoever in selling these shares, right? Absolutely none. I was like, okay, we doubled up our money, but this stock has a long runway of growth that's way past $15 a share, right? There's a famous saying in the stock market, and kind of in, let's call it money game in general, no one ever went broke taking a profit. First off, true. No one ever went broke taking a profit. 100% true. But didn't some people have massive regrets? You sell out a Palantir 15 and then you watch it over the next 2 years, 10x, over 10x. That's gotta hurt. Because you missed out on an opportunity. You made good money. You doubled up your money, you made good money. You 10x plus your money, you made life-changing money. You put $100,000 in Palantir in 2022, right? You double up your money, that $100,000 goes to $200,000 at $15, right? You feel great. Listen, if you just stayed in Palantir, that $200,000 is now over $2 million. Over $2 million. There's a slight difference in the lifestyle you can afford and how you can grow your portfolio over time between $200,000 and $2 million plus dollars, right? A massive difference. So though this is true, no one ever went broke taking a profit. Yeah, but you could also severely underperform the market over time by doing stuff like that. You can cost yourself life-changing money, the type of money that would let you retire early, live in the home you really want to live in, buy the car you really want to buy, right? Have the sort of health care you really want to have, be able to provide for your kids the lifestyle you really want to provide for them, be able to maybe retire your parents if that's a goal of yours, right? All these things, like give to charity, all this stuff that the money ends up producing, that can be the difference between actually fulfilling dreams, financial dreams of like, I want to do this, I want to travel the world, blah, blah, blah. Or like, no, you didn't get there, right? By taking profits way too early. And I'll show you the public count, right? Public count, now $4 million plus portfolio, up, this is calculated by Fidelity Investments, up 186% in the past 3 years, right? Think about where the public account would be if I had sold Meta early, right? Which Meta's made me like 7 figures in profits, right? Imagine if I sold that stock after it made its first run. Palantir. Imagine if I just, cashed out a Palantir $15, $20, something like that. Elf stock. Started buying that stock at 7. Like I could have easily sold that all my shares at, $10, $20, something like that. Tesla, Celsius, all these stocks that have been game changers for that portfolio I've been fortunate to own over the years. Imagine if I just sold them all really early on their runs and I didn't really let them do what they were supposed to do on that run, right? There's no way the public count would be $4 million portfolio today. It wouldn't even be remotely close. The public count likely wouldn't even be a $3 million portfolio. The public count would likely be probably, my guess is somewhere between $1 million range and $2 million range if I had taken profits really early on the runs of those stocks. And once again, there's a big difference between like a $1.5 million portfolio and a $4 million plus portfolio. So the next question is, how do you actually know when to sell a stock and take it out of emotions of like, oh, it went up a lot, so I need to sell? Here's exactly how you do it. Let me explain this to you. You have to back your decision with mathematics. You have to back it with math. This is how you take emotions, feelings, thoughts about it's up a lot, so maybe I should take a profit. Back it with your math. So what you do is you run projections on it. I'm showing you 1000xstocks.com right now and how I run my projections. I'm showing you actual projections I have for Amazon. You run a bull case, you run a base case, and you run a bear case. If my bull case for Amazon did not look that attractive, there's no question I've got to sell Amazon right now. It's a big position for me across my portfolios. If this bull case had a low CAGR here, I would sell out of Amazon right now, every single share. But my CAGR, based upon the revenue growth I have for the company, 26 to 29, and the net income growth, I've been doing a CAGR of 25% plus likely for the stock, which is phenomenal. So Amazon doesn't make sense to sell today. When I run my base case is just a fancy way of saying this is what I expect for Amazon. I expect them to do 12% revenue growth per year on average, 2026 to 2029, 18% net income growth on average, 2026 to 2029, right? 33 to 38 P is very fair for a company growing at those sorts of growth rates. I get a CAGR here of just over 20%. I'm going to take that every time. If you can give me a CAGR of 20% or more on a base case of the company, I'm going to take it. So if I look at Amazon, this doesn't make sense for me to sell. If my CAGR on my base case is 20% or more, there's no way I'm going to sell that stock. There's no way. And even when I run my bear case on Amazon, I'm still getting a double-digit CAGR on this stock. So I could say, well, Amazon's gone up a lot the last 6 months or something like that, right? It's irrelevant. It's irrelevant how much it's gone up or down the last 6 months, 6 years, blah, blah, blah. All that matters is when I run my numbers, the numbers say I'm going to get a CAGR that's likely way above what the market's going to produce. Amazon should significantly, not like a little, significantly outperform the S&P 500 over the next 4 to 5 years. And it shouldn't even be close. And so it doesn't make sense to sell a stock. And that's what you got to do with every single stock out there, right? Now, let's look at a stock that I've taken a lot of profits on here in 2025, right? That's Palantir. I've taken immense hundreds and hundreds of thousands of dollars of profits in Palantir this year, right? Why? Why would I take profits on Palantir? Well, the numbers, the math shows me it makes sense for me to take profits on Palantir. Here's why. I'm showing you my bull case for Palantir. My bull case, this is really bullish in my opinion, but my bull case has them doing 40% revenue growth per year, 2026 to 2029 on average. 50% net income growth on average from my bull case, right? Getting to 42% net income margins in 2029. Having them at 120 to 140 PE, that gives me a great CAGR. The problem is my bull case is not what I expect. My bull case is like an outlandish kind of like, let's say things go all better than I expect. This is how I see it playing out. So if this plays out, I'm in the wrong for cashing shares in 2025. I'll look back with regrets, right? But I won't, and I'll explain that in just a moment, okay? Here's my base case. Here's what I actually expect for Palantir to do for their numbers, 2026 to 2029, and where the stock price goes. Here it is. This is a no bueno situation. So Palantir, revenue growth 40% in 2026. I think that's very doable. I think they can do that number. 2027, it goes down a little bit to 38%. Now down to 35% in 2028, and then 30% revenue growth in 2029. Keep in mind, these are amazing numbers. These are historic numbers. Almost no one can put up these sorts of growth rates Palantir should likely put up under my base case for the next 4 years. And then doing 50% net income growth, followed by 40% the next year, 38% the next year, and 35% the next year. And then getting a net income margins of 37%, which is top tier. 85 to 100 PE, which is very high, but not for a company that's trading at those sorts of rates. It's kind of to be expected. And I get a very low single digit CAGR in regards to the situation. So this is what I expect for Palantir. This is why it makes sense for me to cash shares. So if Palantir goes through its bull case, I'll look back with no regrets. If this stock doubles up and goes to $400 by 2029, I won't look back with regrets and be like, oh man, should have held Palantir. Because I run my numbers. My numbers say, it's time to cash some shares here, sir. So I go cash some shares, right? And if I'm wrong in like the bull case is what plays out, I can live with myself at night. I can look at myself in the mirror and say, dude, like they just happen to do dramatically better than I ever anticipated, and that's fine. Sometimes a company, you got to understand, being an individual stock picker like I am, right, running your own portfolio, sometimes things are going to go way better than you ever anticipated, and you have to be okay with that. Sometimes things are going to go way worse than you ever anticipated, and you have to be okay with that. That's fine. It's part of this game. You're never going to get them all right, right? The moral of the story is when you run that base case, if the CAGR is not there for the next 4 or 5 years, you have to say, makes sense for me to cash my shares, right? So regardless of what happens with Palantir, I will be happy I cash shares in 2025, right? If it goes to $500, it's fine. It's cool, right? Now, of course, I still have some Palantir exposure. We all know that, right? But the moral of the story is here, the numbers, it just doesn't make sense for me to have held all those shares. It makes sense for me to cash, right? Because there's a lot of other stocks I'm running my base case on, and they're giving me CAGRs of 20+%. Amazon was one of them. I just showed you my base case for Amazon. Amazon should likely get a CAGR of 20%, if not over 20%, over the next 4 years. I don't have that happening for Palantir. I have a single-digit return, which is likely worse than probably the S&P 500 will produce, right? Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Listen. Okay, building a portfolio to $10 million plus, that's my goal by 2030 for the public account. How should you think about setting goals for your portfolio? Everybody watching this right now, listen. Whenever you set your goals for a portfolio, make sure it's like a 5-year out goal. Do not, and I repeat, do not set short-term goals for your portfolio as a long-term investor. That's going to end up very bad. You're not going to see me say, I have a goal that I want the public account to be blah, blah, blah number at the end of 2026. No, there's just not enough time to play with there. Anything could happen between now and 2026. The market could crash. The market could have a correction. The market could go complete risk on, fly to the moon. Valuations could push up. And there's a million different things that could happen in the short term. And if I place a goal on my portfolio, that's, let's call 14 months from now, gives me no time to play with there, which means I could end up making a lot of bad short-term decisions that are going to affect my long-term returns very negatively, where I start trying to play this game of like, let me sell out of stocks, let me buy back in, let me go on margin, let me go call options, let me invest heavier on risky stocks than I usually would, things like that, right? I'm underperforming, I'm not going to get to my goals, so let me sell out of my dividend stock. Like, no. Always set like a 5-year out goal for your portfolio. So then you can be directionally in the right place, right? And there's going to be some times you're going to set that 5-year goal and you're going to maybe a little underperform it, and sometimes you're going to way overperform it. I mean, if we went back 5 years ago, right? 5 years ago, how big was a public account 5 years ago? My guess is the public account 5 years ago was probably around $1 million or maybe just over $1 million. So my guess is if I had to set a 5-year goal, I probably would have said $2 million or maybe $2.5 million, something like that, right? We're almost $4.1 million, so way ahead of schedule if I had set a 5-year goal at that particular time, right? So that's great. Like sometimes you come in and beat it. This is not going to be easy for me to grow this portfolio to, from 4.1 million where it's at now to 10 million over the next 5 years. High probability at some point in the next 5 years we have a stock market crash, right? We might have 1 or 2 corrections that amount of time. We'll have plenty of pullbacks. So it's going to be drama filled next 5 years. But the moral of the story is, regardless of what this market throws at me, I need to grow, right? And find the best investment opportunities in the market. And so my goal is to grow this to an 8-figure portfolio by 2030, and we'll see if we go ahead and achieve that. But never set short-term goals for your portfolio as a long-term investor. That will end very, very poorly, okay? By the way, I want to let you guys know before we go further here, effective January 1st, if you have less than $100,000 net worth, you will not be allowed in the private group. So basically, if you have under $100,000 net worth, you should get in there ASAP. That will be the pinned comment down there today. That's access to all my course curriculums, a private Discord chat, all that good stuff. We're already up to 2,620 members in the private group, and I'm not trying to take it much above 3,000 members. Demand to join the private group this year has been ridiculous, and I'm definitely looking to slow it down quite a bit next year. And so that's the plan as far as that goes. So next year, basically everybody that's going to join is going to have a minimum of $100,000 net worth starting next year. So if you want to get in there before, that will be pinned comment down there, okay? Alrighty, next up here. So I posted this on X. This went viral. Once again, my X is always linked in the description area down there if you guys ever want to join me on there. But cash on the sidelines reaches 7.5 trillion. What does this mean overall for the state of the stock market, okay? This means 2 things, very importantly. First one is, this means if we have any sort of pullback, correction, dare I say crash in the market, there's just a ridiculous, unlimited amount of money out there on the sidelines ready to pounce on this market, right? We're talking about 7.5 trillion. And this number continues to build. It's not like this number already peaked and it's starting to go down. This number is continuing to build, ladies and gentlemen, build. So I don't know where this number goes between now and the next crash we have. I mean, there's a potential this could climb to 8 trillion, 9 trillion, 10 trillion, who knows, $12 trillion before we get the next stock market crash. And so that will put somewhat of a floor. It's no guarantee of putting a floor under it whenever the next stock market crash comes, but there's a lot of money out there ready to buy, right? The second thing, that might even be more important in this, is this allows investors to invest in a way that they're not that fearful, because there's so much money over there, right? And everybody's got different requirements as far as I want the market to go down 10% and then I'm going to buy heavy, or 20% or whatever it is, right? And so if you look at it from that perspective, it gets hard to get a crash in the market because there's so many people that really need to get in this market. Let's say you've been, let's take it to I like to take these things to a dramatic example just to kind of illustrate my point. Let's say instead of being invested in the S&P 500 over the past year, you said, I'm all cash, treasuries, okay? So, okay, you put all your money in treasuries, you're probably earning around 4% roughly, right? Around 4%. The S&P 500 is up 15% roughly in the past year. Now, there's a lot of stocks. If you're in some great individual stocks, you've made 30, 50, 70% on your money over the past year, right? Incredible gains. But just being in the S&P 500, that's 11 percentage points of difference there. which, if you've got $10 million in the S&P 500, you've made, $1.5 million return over the past 1 year. Just being in the S&P 500. You have that same amount of money in treasuries, you got a $400,000 return. So we're talking about $1.1 million extra of gains. It's a lot of money. That's a lot of money, ladies and gentlemen, even for somebody that has $10 million, right? So this really illustrates this point of like people, are like, even all these people that are in treasuries are just looking at this market year after year after year. The market's been on a tear for 3 years now. Remember, this market bottomed out right around 3 years ago. I believe it was October 2024 we bottomed. I don't remember the specific date, but I think it was late October, if I recall, of 2022, where we bottomed out this market. It was 3 years ago almost today. 3 years ago almost today. And we've been on an absolute tear for the past 3 years. And if you've been on treasuries this whole time because of all the worries, we had inflation worries, Fed worries, Russia-Ukraine worries, SVB Bank, the regional bank collapse. Oh my gosh, like just a thing after thing after thing, tariffs, just go down the list. There's been a million things to worry about the last 3 years. So you've been hiding out in treasuries and you've gotten, you've gotten what? A return of maybe 15%, 12% over the last 3 years if you've been hiding out in treasuries. If you've been in the NASDAQ, the QQQ, the last 3 years, you've probably gotten, let's pull it up. You've probably gotten 80% return. Would that be right? That seems insane. Is it like, let's pull this up here. This is insane. So your return over the past 3 years, 121%. So you've been hiding out in treasuries. You probably made about 15% roughly, ballpark, on your money over the past 3 years. If you were just in the Qs, you would have made 121%. Oh my gosh. Palantir's at a 2,000% return over the past 3 years. Nvidia's at a 1,200% return over the past 3 years. Unbelievable. Unbelievable. But you've been sitting in treasuries making 15% for the past 3 years when you could have been in Palantir making 2,000%, when you could have been in Nvidia making 1,200%. When you could have been in just the NASDAQ making 117%. When you could have just been in the S&P 500 making 72%. Oh my gosh. And the thing is, if I take you back 3 years ago, a lot of people thought they were genius moving to treasuries. They thought they were so smart. Why? Because one, people didn't want to invest in the market. There was negativity around Biden. There was negativity around inflation. There was negativity around what the Fed was doing. There was negativity about, where interest rates were going from there. And people looked and they're like, look, you can get 5% on a treasury. This is amazing. We haven't been able to get 5% on a treasury for like so long. This is like once in a lifetime, right? And it was a trap. It was a huge trap for your money. The biggest trap. Literally, that was the biggest trap that has been set for your money in decades. Think about that for a moment. The biggest trap in decades was set. And people thought like, this is the way. I'm going to get 5% on my treasuries, 4% on my treasuries. This is a way. Forget the stock market. Oh my gosh, what a trap, man. And that's the way the game plays sometimes, man. It traps you in. You think it's the right thing to do, and no, not the right thing to do. Rough.